Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Middle of the week, Wednesday morning. It's basically another record high. Last night, yesterday, we got a bit of a pause. And that's the lay of the land as we begin this fresh new trading session. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning. And there's, more talk on trade. And Trump has been saying that he could even lower fentanyl-related tariffs on China. But beyond all the trade headlines, there's some very interesting headlines with respect to the mutual fund here in India, proposed regulation and changes there. We'll talk about that as we go ahead.
Well, that's right. We'll address that piece of news. And today we kickstart a new series. That's the November series. October was brilliant. Let's see whether or not we have enough to push even higher. All-time highs should be here in November.
Well, 227, right? Which is not very far away, just a couple of percentage points. We'll see. We've got, so let's just take it from the top, right, in terms of what you need to know as we begin this session. U.S. equities, once again, every day you basically trot up to a new high. NASDAQ was up 0.8%, but basically combination of two things. Lots of AI-related deals and solid earnings as well. So I'll start with the AI bit, which I think is sort of easier to list and attribute reasons to. NVIDIA was up 5% after basically NVIDIA did not just do this deal with Nokia. They basically said that they'll invest $1 billion in Nokia as part of an agreement to collaborate in AI. But that GTC event of NVIDIA was happened last night, and they've announced a bunch of partnerships with companies across the spectrum. And the stock was up 5%. Microsoft ended about 2% higher after a deal with OpenAI that will give it a 27% ownership, which is now worth about 135 billion US dollars out there. Now, Apple, not to be left behind, briefly surpassed the 4 trillion market capitalization and then fell back under it. And more tech, right? Lots of earnings. Meta, Microsoft, Google will all report numbers tonight in the US session. So it's tech and tech. Even from the U.S. administration side, President Trump, for example, is in South Korea, and I think he just made a speech, I think maybe actually underway even now, but basically saying, and there were reports that U.S. may sign a deal on AI and quantum computing with, U.S. administration may sign a deal on AI, quantum computing, etc., with Korean companies and, the Korean government as well. The other bit in terms of Trump, WSJ is reporting that U.S. could cut the fentanyl-related China tariffs from 20% to 10%. This, of course, seems to be, both sides trying to get to a better place by the time that both presidents, President Xi and President Trump, meet tomorrow, and something solid for them on the table. Will we see the outlines of like what's been described like a framework deal without too many details? Most likely, yes. But at least no further, or at least fresh hostilities, I guess, is what the market is excited about here. Gold prices bounced off the 3,900 levels. Oil prices are slightly on the back foot, but macro markets are quiet. That, I guess, is also because the Fed decision is later today, which we will react to tomorrow morning. 25 basis point cut is expected. But more and more attention on what the Fed will do as far as quantitative tightening is concerned and whether this we'll see the end of it. Now, just to tie in the levels, yesterday was a bit of a consolidation across the board, Nifty, Bank Nifty, and the broader indices as well. But the Nifty managed to hold on to the 40-hourly exponential moving average, and we kind of bounced off it. So on the way down, support is in the range of 25,708 to 25,665. And resistance is the high, the range between 26,104 and, of course, the all-time high, which is another 120 points, which is 26,227. Bank Nifty needs to first cross the high of 58,577, which is less than 0.5% away. But if it manages to cross above it, then you've got extension levels which come into play. 58,961 and 59,895 are the other two resistance levels. And support is the low that we saw 3 days back, which is 57,482. So those are levels for both the Nifty and the Nifty Bank out there. GIFT Nifty will give you a quick sense of how we are set up in terms of the start, and then we'll pick up from there. 74 odd points higher is the indicative open. F&O positioning, Nigel is standing by with that. Nigel, over to you.
Well, the October series was brilliant, and even in the final day yesterday, we did see that the Nifty did fight back from the lows of the day. We're setting ourselves up for the November series, and a few factors that you need to note. The FIs, they're short. Yes, the country remains short, but they're not as aggressively short as what we saw at the start of the October series itself. Well, the big question is, the Nifty is doing well, but portfolios are not feeling like the markets are closer to fresh all-time highs. So can we see this rally broadening out? And finally, November is traditionally a good month for the Indian equity markets, with the Nifty up close to around 1.5% on an average over the last decade. And the Nifty Bank is the one that normally drives away the gains. On an average, it's given returns of more than 3% in the month of November. And I'll tell you what, if we need to scale even higher from here, the Nifty Bank will have to be the one that leads the way. But in yesterday's trading session, it was quite interesting. The FIs, well, the buy number was very, very large. We had one large trade out there, but otherwise it appears it's an expiry day-related factor where the futures got converted into delivery, cash market delivery. So the FIs, it appears some of those stock futures have got converted into cash delivery, and that's why that number looked rather large. The DIs, well, they continued their buying ways. So both the institutions were buying numbers. From today onwards, that trend in the FI buying will continue. The good news is, for the last many trading sessions, they've reduced their selling. Well, moving to the rollover position then. If you look at it, the market-wide rollover position, more or less in line. But the Nifty rolls, well, they were much lower in comparison to the averages that we have seen in the past. And that's perfectly reflected in the open interest as well on the Nifty futures itself. It's much lower in comparison to the previous series. That's telling you that some of those shorts, they got covered out. They didn't roll over into the new series. But will we miss those shorts? That's going to be the question, because otherwise we had that cushion of shorts being into the system. We start the series with the open interest much lower. Moving to the FI positioning, well, the FIs, yes, they are short, but not as short as what we saw in the last series. And I think we'll miss them a little bit because you like a market that was aggressively net short. Clients, they're net long, but not as net long as we saw at the start of the last series itself. So the client data as well on index futures will come up for you on the screen. Moving to the other data points, well, I was looking at the options data. The two levels that you're looking at, this high, this 26,300, this seems to be a bit of a barrier. The fresh breakthrough comes once we get past that mark. For the time being, I think the bulls will try to get to that mark, but there will be resistance at around the 26,300. If we get past that, the fresh leg of the rally takes place. But this market has turned into a buy on dips market. And the 20 DMA, 25,500, if that level holds out, you'll be fancying your chances to see trend on the upside, though the 26,300 seems to be a bit of a resistance mark. But the broadening of the rally is going to be very, very important, because the Nifty is very close to the all-time highs, but the Nifty Next 50 is more than 10% away from the fresh all-time highs. So you'll want that to get closer out there. And the small cap index is, well, 6%. So I think the participation from both these two will be important. That's what will make portfolios actually look very, very good. Though the Nifty is on its way to all-time highs, you want to see broader market participation. Finally, the big cues for this series: GDP data will be out, trends with regard to domestic growth, India-US trade talk, very important to get the animal spirits back and make the mood feel much better. And finally, the US Fed data points, as well as what's the trajectory with regard to that. So the November series promises to be a good one. Trend is on the upside, but I think that 26,300 will be an important resistance mark, and the Nifty Bank will have to lead the way.
Oh, absolutely. So let's see if the bulls can actually take some of those levels up on the upside. This morning, Asian markets little mixed. The Japanese market continues to chug along. It's crossing level after level, and today's level was actually 51,000 on the Nikkei. Still trading above that level. The Taiwan market is up about 1%. Even Shanghai, mainland China, Shanghai markets are tracking some gains at this point in time. Australia was the one that was negative because inflation has bumped up quite a bit in Australia, above expectations, some profit taking there. That is the implied open. It suggests that we'll have another strong start to trade. We'll have to see if the bulls can build on that. Almost 100 points up on the implied open right now for the Nifty. Let's take the conversation forward. Mark Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, is with us. Mark, great to have you join in. So first things first, are you expecting a rate cut from the Fed later tonight? And what does that mean for equity sentiment overall?
Yeah, good morning. It does seem to be the case the Fed will proceed with a second rate cut. That's priced in by markets, and so that's probably going to be considered as a non-event. It's really their forward guidance and the Q&A session that will be very important, because there are further rate cuts priced in, not just for the remainder of this year, but also next year. The other thing that market participants will be watching is the extent to which the Fed confirms that they will be concluding their QT program and effectively normalizing balance sheet policy. That's also to some extent expected by the market. And so if the Fed does deliver on those two areas, then it's likely to be an uneventful central bank meeting. But of course, if there's any sense that the Fed is still hedging its bets, still somewhat concerned around its inflation mandate, that could create some volatility for markets across asset classes.
I don't know. I mean, it's not, I think, the base case at all for anyone. But given the lack of data, Fed's going blind, right, in the meeting. They only have this inflation print, but hardly any details on the labor market. If they decide to stay paused today, for whatever reason, absolute shocker for the market, how would that reaction play out? Would there be a substantial downside, or will the market look through it just because we're still in shutdown territory?
That's just not the base case, that they will fail to move on rates. But of course, if we play that hypothetical game in the conversation, then you'll see some repricing out of rate cuts and potential pressure on the front end of bond markets, the bond curves. And that could potentially create some volatility in the more rate-sensitive parts of equity markets. But then the market will be looking through the rationale for that. If the Fed's saying we simply hadn't had enough data, we'll revisit it when the government shutdown concludes, the markets will, to some extent, try to look through that. But if there is a sense that the Fed is doing it for fundamental reasons, that its perception around the data is stabilization or inflation upside risks prevailing again, then that's more likely to have a persistent impact on market sentiment.
Mark, is the sentiment around precious metals turning a little bit?
We take the view that technically, particularly gold, but also silver, became a bit overstretched, overextended. There was a build-up, a re-acceleration of options trading around precious metals. And so this can be seen as effectively a cooling off and a return back towards trend lines, which still look quite positive on a strategic longer-term basis. So we're actually looking at the price action and having sort of locked in some gains at high levels earlier on to see what kind of levels we think represent a better re-entry point. But the drivers of why gold and other precious metals have performed very well over the last 1 to 2 years are still intact. A geopolitical outlook that's somewhat uncertain, a bit fragmented, both fiscal and monetary policy that's skewing towards easing of financial conditions, no real credible plan by some of the major government debt issuers around fiscal retrenchment, and also some question marks remaining around the inflation outlook and the extent to which central banks are looking to diversify their US dollar denominated reserves away from paper towards gold and other physical commodities.
All right. Hi, Mark. Good morning and good to see you. And as always, what about global equity markets? I recall you telling us that you have a fair bit of exposure to Asia, India included as well. As of now, how are you approaching global markets? If you could tell us between, the emerging market basket, developed markets, and where does India fit in? We have argued in the past about valuation reset. Some part of that has happened. Your view in India?
Yeah, at a global level, we have to recognize that the equity markets have performed very strongly in the last few months. Some signs of the early stage of a bit of a melt up. And in that situation, what we're trying to do is participate in that move, but not apply additional capital freely and broadly across any parts of markets. We're starting to get a bit more selective with capital deployment. In an Asian context, we think that Singapore equity still looks strong. The MAS program to encourage deepening and broadening of local equity markets is a positive catalyst. We also recognize that India has seen some stabilization and some recent relative performance momentum. We remain neutral there, but we like it as a diversifier away from the more cyclical markets, such as Northern Asian markets, which have had a very strong cyclical move in the last few months, but perhaps might be at risk of profit taking, particularly in Korea as an example, where, again, from a technical point of view, the market does look stretched in the short term, even though there are reasons to be constructive and positive on a more medium-term basis as well.
Okay, all right, Mark, we'll leave it there. Thanks very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV18. Well, let me just quickly run you through what the interactions are, which are lined up here over the next 2.5 hours. 8:35, Ashish Somaya of White Oak Capital AMC, Sandeep Bagla of Trust Mutual Fund join in. SEBI's proposed an overhaul of India's mutual fund fee structure. So implications there. 9 o'clock, we'll have Rajesh Ravi of HDFC Securities to discuss the second quarter earnings of Shree Cement. 9:20, Pratik Gupta of Kotak Institutional Equities is our market master of the day. 9:35, Abhishek Dadu of Khaitan and Company and Sandeep Parekh of FinSec Law Advisors join in on what happened yesterday, which is a 4-hour delay in trading to start on MCX. Management of Orkla India will be chatting to us. That's the IPO, which is opening, raising about nearly 1,700 crore rupees. Towards the end of the program, it's the economy. Latha in conversation with Jonathan Barrett of ETO Markets and Kishore Narane of Motilal Oswal Commodity Brokers. So commodities in focus there.
Time to slip into a quick break. Got a lot of stock-specific action track for you in a special top 10 segment. I give you a sneak peek. Tata Capital, Mahindra Financial, Credit Access Grameen, Premier Energies, Blue Dart. All of them will be reacting to positive news flow. Add to the list DCM Shriram and CAMS. On the flip side, the asset management companies, Shree Cement and Jindal Steel, could be reacting to negative news flow. Stay with us. We'll get into further detail on all of these names.
Welcome back. So the implied open has been telling us that we'll probably have a positive start to the effect of about almost 80 points because the markets in Asia that are trading, the big ones like Japan, are actually having a pretty good morning, and there's a lot of hope and expectation ahead of the Fed meeting as well. The Fed is expected to deliver that 25 basis points rate cut. So there you go, 80 points higher. Now it's time to talk individual stocks. So as always, let's go across to our team for the CNBC TV18 list of top stocks to watch. And topping that list will be all the AMCs, the asset managers, because SEBI is proposing quite a critical overhaul of the expenses that these asset managers can charge us, the investor. And there could be a reduction here. Sonal has all the details. Sonal.
Well, yes, there are a slew of reforms that the SEBI has proposed. Let me talk about the most important ones. The first one is the proposal to remove additional expenses to the tune of 5 basis points on entire AUM. Now, remember, this was done back in 2018. SEBI proposes to remove it. And Jeffrey says that if there is a cut of around 5 basis points on this, it could impact AMC profits by as much as 30 to 33% if it is implemented by FY27. So that's a negative. They've also proposed lowering the cap on brokerage fees which is paid by mutual funds to brokers when they buy those stocks in the portfolio, right? So cash market transaction that is proposed to be slashed to 2 basis points versus 12 basis points, for derivatives to 1 basis points versus 5 basis points, on which Jeffrey says if implemented, not only for AMCs, it will be negative for institutional brokers as well. 361, Nuvama, all these stocks also will be on our radar. They have proposed reduction of expense ratio by 15 basis points for open-ended scheme, up to 25 basis points for closed-ended schemes. Additionally, they've also said that statutory levies like STT, there's GST, stamp duty, earlier they were a part of the TER or the total expense ratio. Now they will have to be given separately or shown separately to bring in more transparency. But again, these are just proposals. There are comments invited. The last day is 17 November. But yes, on the back of these, AMC stocks will be in focus today.
Thanks for that, Sonal. In fact, we'll have Ashish Somaya, White Oak Capital AMC, and Sandeep Bagla, CEO of Trust Mutual Fund, who will be joining in shortly to further analyze the impact of this. So stay tuned for that conversation. Getting back to earnings then, I'm looking at Shree Cement, and the stock could react negatively actually to the results that came out. But if you look at it in the last 1 month or so, the stock actually has underperformed. The Nifty is up close to 4.5 to 5%, while Shree Cement actually is down close to around 3.5% or thereabouts just in the last 1 month. So the street is anticipating some kind of weakness. Top line was a little better or in line with what the street was working with. The EBITDA was a miss, and that's why margins were a miss as well, and that's why the profitability was a miss. Let's tell you why the top line actually was relatively better. Well, the volume growth was actually quite heartening. Close to around 7% volume growth is what we saw, which is good, 6.8%, which is encouraging. They're growing in line with the market. Remember, in the past, they've been growing, at a pace that's lower than the market. So this time around, that was positive. Even if you look at the premium sales as a percentage of their trade sales mix, that's moved up. That's good as well, which explains why the top line was in line. The problem is in terms of profitability. The cost actually have spiked up more than anticipated, and that's why the EBITDA per ton came in closer to around 1,050 rupees. There was a 30 rupees per ton one-time impact. So even then, it will be close to around 1,100, which is lower than what the street was working with. If you look at it, in comparison to what they did in the previous quarter, other expenditure went up, and that's what hurt them. So net, the stock could open up in the red, but the street was anticipating some kind of weakness in those numbers. And also that 80 million ton target in terms of capacity has been pushed back by a year or so. So expect the stock to react negatively, and then maybe in fact we do see some kind of buying at lower levels. Going to Gaurav though, he's tracking Tata Capital. Gaurav?
Well, as Tata Capital, when we look at the numbers, inline set of number is what we call, remember, this is the first quarter where they are actually reporting their numbers post their listing. When we look at the numbers, net interest income that increased almost by 17%, PPOP growth was at around 12%, almost in line. And when it comes to profit, that declined almost by 3% on a year-on-year basis, but it was actually expected by brokerages. In fact, when we look at provisions, they have now declined on a sequential basis. And as a result, when we look at credit cost, that has gone down almost by 30 basis points. ROAs, they have improved almost by 10 basis points, and when it comes to net interest margins, they have also improved almost by 10 basis points. Now going ahead, another key thing which will keep the stock in focus is that they have given guidance for FY26, which is actually optimistic. When it comes to AUM growth, they are saying 18 to 20% growth is what we can expect, and at the same time credit cost, they are likely to see that credit cost is going to go down almost to 1.2% versus what it is right now at 1.3%. ROA, they are guiding between 2 to 2.1% versus what it is right now at 1.9%. And lastly, when we look at profit growth, they are expecting 35% growth on a year-on-year basis. Remember, they have reported decline of around 3% in this quarter. So definitely an optimistic target is what they have kept for FY26, and this is what will keep the stock in focus today.
All right, thanks a lot for that, Gaurav. Well, I'm looking at Jindal Steel. And in yesterday's trading session, the street seems to be sniffing good numbers. The stock ended virtually at the high point of the day. But the numbers, actually they're a little bit low on adjusted basis. Let me explain. Top line, more or less in line or mildly better. The reported EBITDA number was better than what the street was working with, and so were the margins as well. And the profit number more or less in line. But the adjusted EBITDA number needs to be taken note of. And in that case, it was actually a little bit lower. So the run-up in the stock then, could result in the stock actually seeing some red just to kickstart trade today. Because there was a forex gain of close to around 200 crores, which is much higher on a year-on-year as well as on a sequential basis. And the volume parameter, there was not expected to be any kind of big operating leverage playing out because they had a shutdown and also they're expanding capacity out there. The adjusted EBITDA, well, that as well, did come in lower than what the street was working with. That's a standalone business that we're talking about. And the EBITDA per ton number was lower than the 10,000 rupees odd that we were forecasting. Some part of the additional cost will be because of startup costs since they're expanding capacity out there. So the numbers actually, going by the kind of stock reaction that we saw yesterday, I mean the preemption that we saw, the stock ended higher in trade yesterday. The numbers are not that big a beat, in fact a little bit lower. But what is good to see is the capacity expansion is progressing well, and the net debt actually had come down marginally, though they've incurred a massive capex as they scale up capacity. So going with red on Jindal Steel, but possibly the stock sees some kind of bottom fishing during the trading session. Going back to Gaurav, Mahindra Financial and Credit Access Grameen. Gaurav, take it away.
Well, let's begin with Mahindra & Mahindra Financials. When we look at the numbers, those were actually higher than expected. So let me quickly take you through the numbers. Net interest income that increased almost by 23%, PPOP growth of around 25%, and when it comes to profit, it grew almost by 54% on a year-on-year basis. What remains a key thing to watch out is that net interest margins, they have expanded almost by 23 basis points, and at the same time, when we look at credit costs, now, although it has increased almost by 30 basis points, it was actually expected because they had already given some shade on that during the quarterly updates. Another thing to highlight is that during the con call, they are saying that AUM growth is going to remain somewhere in the range of 15% for FY26. Net interest margins, they are going to be in the range of 7%, and credit cost will remain in the range of 1.7%. So definitely, in terms of guidance also, they are being a bit optimistic. Apart from that, when we look at Credit Access Grameen, numbers look great. When we look at net interest income, we saw 4% growth. In fact, PAT, that has declined almost by 34%, but on a sequential basis, we are seeing an uptick. What is a key thing is that when we look at the con call highlights, during the con call, they have said that credit cost guidance that they have given of around 5.5 to 6%. In this year, they see 70 to 100 basis point of upside risk to that. And at the same time, another optimistic guidance that they have given for FY27 is that ROAs are going to be in the range of 4 to 4.5%. Now, this will be aided by 20% growth as per them. Remember, their loan book growth was at around 3% in this quarter. So definitely optimistic guidance for FY27 for Credit Access Grameen as well. And on the back of that, we will be watching out on this stock.
All right, Gaurav, thanks very much for that. Stock's done very, very well. Basically, it's almost doubled from the lows of a few months back, actually. So almost 1,500 rupees now, but 750 or so where the stock had fallen to. Premier Energies is the next one we want to focus on. Vivek is here with, the numbers which came through. Vivek, over to you.
Well, good morning. That's right. So Premier Energies, again, a good quarter for the company. Revenues have jumped up over 20% on a year-on-year basis over the 1,830 crore mark, now led by operating leverage benefits and also tight cost controls. EBITDA has jumped up over 47% over the 560 crore mark. Now, EBITDA margins too has expanded almost 500 basis points on a year-on-year basis. On the back of that, profitability higher by 71%. Now, the key positive from this particular Q2 is the fact that there has been significant order book addition from Q1 to Q2. So order book now stands at almost 13,215 crore versus just over 8,600 crore, on a sequential basis. So that is significant order book accretion. Now, when you're talking about the new bookings, almost 6,483 crore, and the order book volume right now is at 9.1 gigawatts. So strong results across all parameters. And also the company has ventured into new segments, which is something that investors will be key to watch out for, how those can scale up.
Okay, so we'll keep Premier on our radar. Vivek, thank you very much for that. Let's head across to Manglam. Blue Dart's numbers came through. Manglam, how do they look?
Well, so second quarter is seasonally the weakest for logistics companies, and this time around there were a few disruptions, etc. as well when it came to rains. But despite that, the company actually did fairly well, a 7% revenue growth. But look at the operational performance, 15.5% growth in the EBITDA, which meant that the margins expanded by over 100 basis points, and the net profit grew nearly 30%. More importantly, where we are at right now, the business end of the year, the third quarter, is fairly strong seasonally for all these logistics companies because of the festive season. And now the fourth quarter as well, start January. Remember, they had announced a price hike, which is their annual price hike of almost 9 to 12%. So that's a positive. So next two quarters look positive for Blue Dart as well. And the second quarter, which is seasonally weak, in which they showed operational improvement, I'm going with green for that one.
Okay, all right, Manglam, thanks a lot for that. Well, let's go across to Sonal. She's here to tell us about DCM Shriram and CAMS. Hey, Sonal.
Well, yes, both of them reported numbers. For DCM Shriram, looked good on a YOY basis, but do remember they had made an acquisition of Hindustan Specialty Chemicals, and that's why the numbers look elevated. Revenues up 20.6%, EBITDA up 71%, margins at 9.4%, and net profit also at 160 crore rupees versus 63 crore rupees. How much was the impact is something we'll understand from the management today. But they've also proposed acquisition of Saltworks for backward integration in one of their segments, and the acquisition cost is around 175 crore rupees. For CAMS, it was an all-time high quarterly revenue of 376 crore rupees, which was up 6.5% on a sequential basis. EBITDA was also up 8.5% on a quarter-on-quarter basis, with margin expansion of 93 basis points. Their profits also went up by 5.5%, so going green with CAMS as well.
Okay, all right, got that. Sonal, thanks very much. Let's quickly recap our list of top stocks to watch, the ones that have positive news flow around them. Tata Capital, M&M Financial, Credit Access Grameen, Premier Energies, Blue Dart, DCM, Shriram and CAMS. Stocks with negative news flow, of course, would be the asset management companies. There is, of course, Shree Cement and Jindal Steel as well potentially on the red side today. Okay, well, with that, let's hop across to Manisha to figure out what's the latest in the commodity markets. We know that precious metals have been cooling off. Manisha, what's the big headline? And before we get to that, I mean, all okay finally with MCX?
Oh, yes. We would know that very, very shortly, 9 a.m. and when it opens. And yesterday, after 1:25 p.m., after the exchange open, it was a smooth trading with volumes coming back to as normal as what we see every day. And 9 a.m. is what we'll know on how that starts. But having said that, if you look at the commodity prices, well, I have to talk about copper and start with that first because copper is the new gold, remember, and we've seen a lot of money come into this one. We are trading near record highs for this. We are just about less than $100 away from an all-time high into this one, a 4% of a jump jump on a week and 7% up in this month itself. Well, apart from all the supply concerns and mine concerns that we seem to be getting in from Chile and Peru and Indonesia and Congo for that matter, it also has to do with the strong demand expectations coming in from China. Their plenum meeting clearly says that they're going to be looking at tech and manufacturing. So tech, when you talk about that, copper is going to be a big contribution into that. So that is where copper seems to be getting support from. In the other commodities, it is the crude oil prices you need to keep an eye on. 3 days of constant decline and $60 a barrel has broken on the lower side for the WTI prices now. It's going to be a third monthly decline coming in from prices, especially after OPEC says that they are considering another output hike in its upcoming meeting. Street also will watch out for the US and China trade talks. There have been various statements coming in from that, but majorly it is, of course, going to be about the US Fed meeting announcement today in the evening, and that is where most asset classes would get their cues from.
Manisha, thank you very much for that, and that's the big one, but that's later in the US session. We'll take a quick commercial break here. We're going to come back with Amnish Agarwal of PL Capital for some fundamental stock conversation. We'll also have Ashish Somaya and Sandeep Bagla to talk about SEBI's proposals, draft regulations as far as mutual funds are concerned. Stay tuned.
Welcome back. Well, as promised, let's get to some fundamental analysis then on the stocks that will be reacting to results first up. Then we'll discuss the AMC, part of business. Amnish Agarwal, Director Institutional Research at PL Capital, joins us on the show. Hi, Amnish. Thanks a lot for joining in. Let's address a couple of big numbers, the ones that I track in particular. JSPL, what's the view out there? Yesterday, the street seems to be sniffing something. And the street has gone into this bullish train on metals. And with metals, you don't look at valuations, look at momentum. However, the numbers appear a little bit subpar. What's your view on it?
You see, the metals, people are actually talking about a structural story whereby the overall capacity addition, even at a global level, has been on the low side. And that is why the analysts are of the view that in the longer term, the metal prices cannot remain where they are. And as the prices go up, then eventually whatever incremental comes will flow into the bottom line. In the near term, whatever the profitability increase we have seen even in 1Q or 2Q, so that is more or less propelled by the higher margins due to the benign input prices. So as of now, I think it is like a mixed bag. The volumes have not been, I would say, that great for the industry, even in the 2Q, maybe due to extended rains and all. Even the pricing has been under pressure. And for JCPL, the prices of, say, your longs, where they are very strong, so that has also been an issue in the recent past. However, the capacity expansion, I think that seems to be, you can say, on track. So I think once the capacity comes on stream and you have got more, you can say, volumes to play around, and you're expected, you can say, prices likely to be, you can say, firm in the medium to long term. That is what is actually driving the steel stocks. In the near term, yes, due to the soft prices of demand, there could be, you can say, variations in the stock. I think on a broad base across, you can say, steel stocks, but the medium-term outlook remains positive on the steel companies.
Okay. Amnish, do you track Premier Energies? The numbers look very good. Q2 numbers.
No, we have not been looking at that.
Okay, you don't track that stock. What about this proposed regulatory change for asset management companies? I mean, they don't have that additional 5 basis points they could charge, in case of exit loads. Now they can't charge 12 basis points for brokerage. It has been capped at 2 basis points. So, I mean, first glance, it seems a little negative. What's your read-through?
You see, as far as AMCs are concerned, there have been changes in the regulation in the past also. But if you look at, say, the recent one where, first of all, your the exit loads you cannot charge, and then the brokerage has been capped at 2 bits. Now, if you look at, say, your first the exit loads, I think there would be, you can say, some sort of a pass-through which might actually happen, because once anyone exits, there's a cost actually associated with that. So that is on one. The second is on your brokerage, which is 2 bips. I think 2 bips actually it is a bigger worry for the broking industry than for the mutual fund industry. But having said that, my sense is that the average brokerage rates now in the domestic industry that won't be more than 6-7 bips. So there could be, you can say, some impact of that, but that I think 2 bips is something which is something like unsustainable. And how the industry tackles it remains to be seen, both on the broking side as well as on the AMC side.
Well, here, I don't know, Amnish, if they'll find a workaround, because SEBI's rationale is that, look, if you're saying that this is 12 basis points because it's broking cost plus research, then that's not fair, because you're charging for research separately in the expense ratio anyway. So, I mean, I don't know if there's a workaround. But anyway, purely in terms of stocks, do you have any picks in the space from the mutual funds that are listed?
You see, on the mutual fund side, I think we are tracking most of the important names, and here particularly HDFC, AMC. I think that is one stock which looks interesting, followed by Nippon AMC.
That's what I'm saying.
Actually, we should look at some of these stocks. You've got HDFC AMC, which is up on your screen. Look at UTI AMC. Just put these up, stocks up. Nippon, we should pull up as well. And a bunch of others. Actually, even distributors, there's one large distributor which is listed, Prudent, which also we should pull up. The chart we should pull up. And of course, I mean, brokers, but the impact perhaps will be more on brokers. But, in terms of the ones which are listed, I think most are on the retail side. It's sort of Motilal Oswal. Motilal, of course, has institutional broking as well. But, in terms of trying to assess the implication for the business overall, because they've got so many other things as well. So pure institutional brokers who are listed, there aren't many. We'll be, by the way, speaking to Kotak Institutional Equities a little later, 9:15 maybe. That they'll be a good sort of, a person to ask what the implication on the broking side is really. Nuvama 361, these are the other ones which we should kind of look at as well, because they also have a lot of distribution business. So have companies like Motilal Oswal, etc. Remember, this is, all this was, these proposals did come through a couple of years back. They didn't go anywhere. These draft regulations came, but they didn't really go anywhere. Now they're back on the table. These are draft regulations, but I mean, the general implication across the board is going to be if reducing earnings across the value chain. For investors, for you and me, it basically means lower expense ratio, lower TER, so lower costs of buying mutual fund units, but varying degrees of impact across the board with regards to the ecosystem, which is mutual funds, broking, and of course distribution as well.
So just to simplify this for our viewers, I mean, essentially 2 parts to this. What is the regulator essentially saying? The regulator is saying that when you talk about the expense ratio for fund, that expense ratio includes all the costs involved with managing that fund, including the fee that's paid to the fund manager, their expertise, the in-house research, etc. So then if you say that I have to pay 12 basis points as brokerage, because that includes research which the broker is providing, then that in effect is double charging for research, and that the regulator feels perhaps is not that fair. That's one part of it. The other part of it is making sure all the statutory levies, which is GST, which is CTT, which could be stamp duty, all of these levies now have to be X of the expense ratio. So it's very, very transparent.
GST is already X.
GST is already X.
The other statutory expenses are
part of the
They have to be separated.
Now they have to be
the
separated.
bigger implication for mutual funds is that a 5 basis point, which is that exit load. Let's actually bring in Ashish Somaya, who's with us of Vito Capital. We also have Sandeep Bagla of Trust Mutual Fund. Gentlemen, great to have both of you here. Good morning. Ashish, you're the man with with all these numbers on your fingertips in terms of how the costs break up, because you've run the business and you are running the business. So implication across the value chain with what has been proposed now, if this were to go through.
So first up, Prashant, I was listening to you, and I think obviously the key takeaway is that for let's say you and me as investors and our viewers at large, it's really positive on 2 counts. One is obviously because mutual funds do have transactions and turnover. I mean buy sell trades, And obviously, if you assume, of course, the cost incurred was not actually 12 basis points. On an average, it would be lower. But net, if they're saying that the cap is down from 12 to 2, a couple of clarifications. First, of course, it will reduce the cost of transaction, and to that extent, the alpha generated by funds, to that extent, should actually go up because the benefit will go to investors. Second thing is that if you think of brokerage or whatever is paid to brokers as 12 bips, it's not entirely paid to brokers because there are components like exchange fees and stamp duties and STT and so many things out there. So it's not like 12 becoming 2. It will be more like, say, if say as per the regulatory paper, if it was 10, it might become like 4, 5, 6 or something like that. It will settle at because everything doesn't go to the broker. What the broker bills, there are further components into it which go to exchange and stamp duty and all those kinds of things. But yes, that will benefit investors. The second thing to keep in mind is that when you look at the, statutory levies within the TER other than this. So like you rightly pointed out, GST on the management fee was outside the TER, but let's also understand that there are various other components of operating expenses that we pay. Depending on the size of the fund, we may be paying anywhere between 8 up to 14, 15 bips as operating expense. And that has, say, the registrar's fees, it has the custodian's fees, a lot of other operating expenses we incur. Everything has a GST component in it. So for a moment, if I say that the OPEX is 12 basis points, you must assume that it is more like 9.5 plus 2.5, something like that. Because that 2 to 2.5 basis point of statutory levies, which is there in all the OPEX, that was also going from TER. So that has to be actually moved out. Then obviously one needs to wait for, further straightening out or, clarification on this. But there are other components in the TER also where there is a GST, which was actually hidden inside the TER. So net, lot of rationalization. And
what about that 5%, Ashish? 5% on...
5 bips.
I think that 5 on exit load, which you could charge, right?
Yes.
But that basically, it was not there pre-2012, right? So you're basically going back to that regime. It was introduced, I think, in 2012.
It was brought in when exit loads were removed in 2012.
Yes.
In lieu of that, it was 20 basis points and it was reduced to 5 basis points in 2018. And now it has been abolished. So how big a hit is that, Ashish?
Yes, so yes, that's what I'm saying, that net, I think the TERs will go down. There is no doubt about it, because while the regulator has said that we are trying to remove all these components from the TER, and to that, so if that becomes X-TER, then we are trying to reduce the TER and remove these components and make them TER++. But
is it bad for business, Ashish? That's the simple question. Now that you can't charge this additional 5 basis points and all the other, statutory charges have to go out of TER. I mean, if you look at the rationale the regulator has put out, it seems very clear. So I want to know how much is the expense ratio, GST, stamp duty, etc. is all plus.
Yes,
and
I think that...
Yeah.
Sorry. So you're right that at least that 5 basis points plus a bit more. So that will be, it depends what the AMCs take a hit and how is it shared with the channel going forward. But for the investor, I think the TERs will come down even after making all these adjustments of removing from TER, adding plus, etc. Net TER will go down. So the industry has to, figure out how to absorb that.
This is, gentlemen, I don't know if you agree, Europe has this MiFID regulation, right, which was brought about a few years ago. This is like India's MiFID moment. If this goes through, Ashish, you would agree?
Yeah, to an extent, it is looking like moving in that direction, especially when you talk about the cost of transacting and, brokerages, etc. But I think, over a number of years, what has happened is, as asset management companies' scale and size has increased, people have invested heavily into research, right? And not just the large AMCs, even, players like us, say we are more like 10 billion in size, but even we have a very large research team. At the same time, I would say that brokers don't just do transactions. There is definitely a lot of value addition, but I think we have to, arrive at some kind of working equation.
Okay, Mr. Bagla is also with us. Now, Mr. Bagla, you tell us, I'm asking a very simple question. Does this impact profitability? Will profits and margins for asset managers come under stress? That's the big question that shareholders of listed AMCs need answers to.
So, SEBI has proposed that what we charge, the total expense ratio, be reduced by 15 to 20 basis points. And lion's share would probably be reduction in distributor fees also. And some of the expenses like GST, STT, CTT, are now allowed to get charged. So the impact will not be as much as the top line suggests. And it depends on how much distributor fees are also compressed by the AMCs. So in the short run, yes, there would be an impact in terms of lower fees when this goes through. But over a small to medium period of time, I think it will adjust. And if, looking at the growth at which the mutual fund industry is growing, I think we will see it as a small blip in the longer term.
Ashish, comment on this point. I mean, it essentially boils down to just this, right? How much can you compensate by lowering the distribution fee and the commissions, and how much can the AMCs absorb? Right now, what's your, I know it's very early days. If this goes through, can 50% be absorbed and, the share is 50-50 between distributors and the product manufacturers? How will it play out? The hit.
So listen, I think that 5 basis points plus, that 10 to 15 basis points depending on slab. So let's say that net the regulator has spoken about reducing about, say, 15 to 18 basis points, right? And then let's say we benefit 2-3 basis points because a lot of the stuff which we're absorbing goes outside the TER. So I think, all told, if you really ask me, the industry has to contend with figuring out how to manage this. I think it will be 10-12 basis points, not more, which is what the knock will be. But 10-12 basis points is a significant number. And yes, within that, clearly, we have to arrive at an equation. Now, different players will have different equation with the channel partners, but it will have to be split. Because ultimately, if let us say on an average 60% is going to the channel partner and 40% is going to the AMC in terms of retention, then it's only fair that even the knock is split accordingly. So I think that will be the bare minimum. So ultimately, when you ask about AMCs, it will boil down to low single-digit basis points of impact.
Yeah, and of course, I mean the larger AMCs will be better off. The smaller ones. Upstarts and a lot of new licenses, etc., coming in as well as they try and build up assets, etc. I mean, the impact will be more naturally. We'll leave it at that, gentlemen. Good perspective on this matter, Ashish and Sandeep. Great speaking with both of you. Thank you very much for joining us. We'll take a quick commercial break here. We're going to come back with a focus on the big movers on Dalal Street yesterday, and of course the volume, price action, etc. Stay tuned. Coming up. Okay, welcome back. 7 minutes to go for the pre-open session. Let's bring in Sud now, who's looked at the big movers from yesterday and, of course, the delivery stats, volumes, etc. So take it away.
So first on the list is Carter Technologies, which has reported Q2 earnings yesterday, and those earnings looked very strong, in which margin was 33% versus 21% in the same quarter last year. And now company is saying that it's targeting margin in the range of 55 to 56% in the near term. And as far as the stock move is concerned, yesterday's gain, single-day gain, was highest in last 2 years that company has seen. And the last 1 year, stock has almost tripled. Now, as far as the total volumes, 57 lakh shares saw a change of hands on Tuesday versus 20-day average of just 6 lakh, and of total volumes, 8 lakh shares were marked for delivery versus 20-day average of 1 lakh, and this delivery volume that you have seen of 8 lakh, that was highest in last 2 months for Cartrade Technology. Second, Newgen, again, this also has seen a big move after Q2 earnings, and those earnings were very strong. It's the 5th time in 2025 the stock has seen a gain of more than 10% in a single day. And on volume front, 1 crore shares traded on Tuesday versus 20-day average of just 11 lakh, and 12 lakh shares were marked for delivery versus average of 2 lakhs, and this delivery volume was highest in last 1 year. Another interesting name is IFB Agro. Remember that company is going to report its earnings on October 31st. And ahead of that, in last 3 sessions, company has been seeing a big move and has gained in the range of 7 to 9% on each day in the last 3 months. And in the last 6 months, stock has almost tripled, and it's up more than 200% from 52-week low that stock has seen in April of 2025. Yesterday, it saw volume of more than 3 lakh shares versus 20-day average of just 80,000, and 7 lakh shares were marked for delivery versus just average of 20,000. So these are the 3 stocks that had seen big volumes.
Okay, all right, sir. Thanks a lot for that. Well, we're still in conversation with Amnish Agarwal. Amnish, what about some of these companies that came out from the NBFC space, Mahindra & Mahindra Financial Services, Credit Access Grameen? Did you have a look at those numbers, and what do you like from that space?
I think the NBFC space actually should gain incrementally going forward because, first of all, your NIM expansion should happen. That is one. The second thing to look is that in the broader NBFC space, because the consumption demand is expected to improve. Now, whether these are, you can say, the funding of PVs, whether these are durables, whether these are, you can say, some of the other autos. So I think this entire space should see, particularly on the NBFC side, which are catering to all the consumer as well as auto segments, I think they should see some pickup in their credit growth in the coming months. So that should actually result in the better numbers coming from most of the NBFCs in the second half of the year. And I think as the overall momentum in the economy improves, I think even the stress factors from the bottom end, so that should also be solved.
All right.
In the NBFC space, Bazaar and Chola are the two stocks which we like at the present time.
Got it. Okay. All right. Amnish, thanks a lot for joining in. Wishing you a good day ahead. And we chat up, rather soon. For the time being, slip into a short break. Come back. Pre-open rate will be with us. We'll also be joined by Sudarshan as well as Mitesh, who will give us the technical calls.
Okay, well, market pre-open coming up any time now, and let's just look at we will look at the rates in a bit from now as things settle down. Sudarshan Sukhani is with us, so is Mitesh Thakur with what they'd want you to do in terms of trades this morning. 30 points higher, I think it's the first indicative rate as it starts to appear. So quiet, and yesterday's close was also not quiet. I mean, there's the final close looks very quiet, but it was anything but quiet. Last 30-40 minutes, both Nifty Bank saw sharp recoveries. Sudarshan, Mitesh, good morning again. What would you do, Sudarshan? What's the advice on indices?
Yeah, good morning. See, the advice is the same. The trend is up. We had a very sharp correction last week. That's behind us. Yesterday's movement should be ignored because it was options expiry weekly as well as monthly. So strange things can happen. That doesn't disturb the larger trend. So with an uptrend in place, we want to be buyers. If you have long positions, stay with them. If you don't, buy on a dip, buy on small corrections. Yesterday was a dip. If you have the courage to buy it, keep a stop at 25,800 and then let the market take over.
Okay, got it. Thanks for that, Sudarshan. Mitesh, coming across to you. What's your view? We're coming after a solid, it was an Oktoberfest actually, a very good. You have 5% return on the index itself. Where are we headed from here? I think that 26,300 mark seems to be like a bit of a resistance. But what's your take? Nifty Bank.
Good morning, Nigel. I think that's the level, which I'm watching. Actually, 26,200, give and take a 30-40 point kind of range because I was working more on the closing charts. But broadly, the direction is positive for me. And therefore, I think, after a good October, if you get a couple of days of consolidation, and within that, if you get pulled back to about 25,600, I think that would be an area where I would want to explore aggressive long positions. And once we get past this 26,200, 250 areas, then I think, we might look at the rally continuing and extending much on the upside.
Okay, let's get to individual stocks then. Mitesh, you go first.
So I have more of buy calls today, 3 longs to a sell. On the buying side is BHEL, which I would recommend buying the stop at 234 for a target of 245. JSW Steel made a fresh swing high, so buy the stop at 1164. Look for targets of 1230. And UPL had a good price volume action yesterday, so buy here at the stop at 683 for a slightly positional target of 740. One sell call, that's NHPC. Keep a stop above 86 and look for target of 81.
Got it. Okay. What about you, Sudarshan?
Well, it's an all buy list. LIC is a buy with a stop under 885. LIC has a very attractive chart. So if you're looking for a positional trade, some kind of a short-term investment, it qualifies. Titagarh is a buying opportunity with a stop under 880. Chambal Fertilizers, which rarely comes in my list, is a buy with a stop under 480. And finally, SAIL, Steel Authority, is a buy with a stop under 130.
Got it. Okay. All right. Thanks a lot, gentlemen, for that. Well, let's focus on the cement pack. And Shree Cement is a stock that will be reacting to its numbers. Let's pull up, we'll get the pre-open rate in just a bit. The numbers actually were a little bit disappointing. There's no volume actually in pre-open. And if you look at it in the last month or so, the stock has underperformed what the Nifty has done by close to around 8%. Top line, well, that was in line, a little bit better. But EBITDA performance as well as margins were a little bit lower. Now, on the top line, the reason that it was a little bit better is because they grew by close to 7% on volumes. Remember, they have been mentioning value over volumes. But this time around, volumes are good as well, which is industry growth rate a little bit better. So good on that. That means they haven't lost market share. Also, what supported the top line was the premium products as a percentage of the trade mix. Well, that's moved up as well. So that obviously supports realizations as well. The problem was on the EBITDA per ton front. And yes, there was a one-time hit of close to around 30 rupees per ton. But even taking that into account, the EBITDA per ton number was actually a miss in comparison to expectations because other expenditure did spike up. It was because of higher repair as well as maintenance cost that hurt their profitability out there. So the numbers go down as a bit of a miss. The street seems to have anticipated that. Also with regard to their 80 million ton capacity target, it seems from around 2028, now it's been pushed to around 2029. To help us out with a quick analysis and what's the view out there, we have Rajesh Ravi, institutional research analyst, who joins us on the show. Hi Rajesh, good morning, good to see you in. What's your view? Shree Cement, I was just looking at the chart, actually the stock had corrected more than 10% from the 52-week high. These numbers appear a little bit soft. The bigger problem is you have Ultratech Cement that's gradually getting more aggressive in North India. What's your take on Shree Cement first?
Yeah, hi, good morning, Nigel. Shree Cement, yes, this quarter, they're disappointed on the results. EBITDA is down 10% versus last and consensus numbers. So, as you mentioned in your opening remarks, they are focusing more on value over volume, and that has reflected. If you look at the 6 quarters volume, that has been more or less flattish, whereas the industry has grown at 4 to 5% CAGR in the past 6 quarters. So, and during the call yesterday, the management did note that their focus on value has yielded them in resulting better realization growth even during H1, which is around 9% vis-a-vis the industry. If you look at even Ultratech and all the other reports, results which have come through so far, their realization growth is sub 5% on an average. So that is what is yielding into this healthy margins compared to the industry. However, at some point in time, because the management did hint that they want to grow faster than the industry, this value over volume strategy need to be moderated at some point in time. This is one. Second, on the expansions front, the management did indicate that they are not in a hurry to target that 80 million ton and even can be pushed into FY29 if that be the case.
Okay, so but what is your view on the stock official rating that you have, Rajesh? And also, for the last many years that we have been talking, I think close to around 10 years, Shree Cement always highest multiple is what they get. Now, some of those, those advantages that they have seem to have skimmed out, whether it's with regard to pet coke usage, whether it's with regard to the lowest cost producer, or whether it's with regard to their dominance in North India, seems to be challenged out there. So what is the multiple you give it and what is your target price?
So you're right. We are valuing it at 17 times and we have an ad rating currently, with 31,000 odd target price on an average 31,000 target price is what we have. And you're right, the valuation multiple which Shree Cement has been commanding at the top, the top best multiple in the industry is now even being ascribed to companies like Ultratech and even Ambuja. Given that these two players have become aggressive on their volumes and margins front also, they have started to deliver strong margins because they have toward the cost efficiencies line. Shree Cement, incrementally the cost saving metrics are limited because they're already north of 60% on green power, whereas others are catching up. So over next 1 year, even Ultratech would be reaching close to those numbers. So that is where the delta on cost savings for companies like Ultratech is much higher compared to what Shree Cement would scale from here on. Shree Cement has guided 100 rupees savings from logistics cost, which they will have incrementally coming over 1 to 2 years.
Okay. All right. What about North?
North Market.
Yeah, North Market.
Yes, North Market, Ultratech in phase 4 expansion, they have announced that they would be adding, out of 23 million ton, large chunk of the expansions will happen in the North and Central market to address the, or peak utilization which the companies are facing in those markets. So that will also have a bearing on everyone, including Shree Cement. Even if you look at Shree Cement performance, while their consolidated utilization would be, for H1, the India utilization would be close to 53-54%. Fair to assume the northern part utilization would be much higher. It is most of the assets in the newer geographies like West and South, their assets are underutilized. And there's a lot of clinker grinding capacities which the company has debottleneck, and that is why the utilizations appear low. So indeed, they will face competition from companies like Ultratech and even Ambuja, which will be scaling up their capacities in these markets.
Okay, very quickly, Rajesh, if you could tell us what is your feedback that you've got on ground. For these cement companies, a little lucky. First quarter is a little soft, then they say second quarter is monsoon, third quarter there's festive season, and that keeps getting kicked down the road. At current reckoning, what is the feedback you've got with regard to demand on ground? What is the demand growth for the industry you're working with? And any price hikes you're working with?
So let me first talk on demand. H1 has been a washout. Even on a low base, we are looking at 4 to 5% volume growth at best for the H1. October has been a peak festival period, so obviously demand has been subdued. There is hope that the second half should look good in terms of demand, that all the drivers are in place. So, second half, we may grow at 7 to 8%, while the industry is looking at 10% plus. I believe most of them, there could be disappointment on those 10% growth numbers. But 6 to 7% growth should be doable. And we are factoring in on an average volume CAGR for the industry at between 6 to 8%. Coming on the realizations front, October, post GST cut, not only in cement, even in other segments, companies have clearly indicated that government is monitoring the price movement strictly, and obviously cement companies have said that they have passed on the GST benefits fully. We don't see any price increase happening through in next 2 to 3 months.
Yes.
In fact, there has been some softening in prices in the eastern market beyond GST in the month of October, maybe due to the festive dampness and demand. So at best, we should be working at flattish realizations over next, at least in Q3. Q4, there could be some uptick in the later part of the quarter when demand picks up.
Rajesh, always good to hear your thoughts. Thanks a lot for joining in. And as the cement sector results start pouring in, we'll chat up once again in the month of November. Wishing you a good day ahead.
Thank you. Same to you.
Well, let's get in Sudarshan now. He's joining in to give us his 9-10 call. Sudarshan?
Well, it's Chambal Fertilizers buy with a stop under 480.
Mitesh, what about you?
I go to buy on JSW Steel. Look for a target of roughly around 1230.
Okay, got it. JSW Steel, let's stick to the ferrous space. Jindal Steel came out with a set of numbers and the street was sniffing something yesterday. Stock ended high at the high point of the day with a gain of around 3.5%. However, the sniff didn't prove to be right because his numbers actually on the adjusted EBITDA basis, that's X of the Forex gain, actually, as you can see, adjusted EBITDA is a little lower than expectations. The absolute EBITDA or the reported EBITDA actually was a little bit better. So X of that was a bit of a miss. Remember, volumes are expected to be flattish, and that was the case. The adjusted EBITDA, even for the India operations, the standalone business, that came a little bit low at around 1,752 crore rupees, which means the EBITDA per ton came in at sub 9,400 rupees per ton. The street is working with a number of close to around 10,000 rupees. Keep in mind they're expanding capacity, so some part of the startup cost could have impacted them, and that will be one time. As the operation leverage plays out, that actually will gradually get absorbed. So that's why the stock, I think, is opening up with a mild downtick of close to around 1%. The street is looking ahead. Capacity addition is coming on stream. The debt number has come down mildly, keeping in mind that they incurred 2,500 crores of capex, which is heartening. So a mild red tick on this one.
We'll take note of that. Nigel, Jindal Steel in focus. Just a quick recap of some of the stuff that we've addressed since the morning and how they're all settling down in the pre-open session. So these are the AMCs, HDFC, Aditya Birla, Canada, Robeco, etc., down 3-4%. There are others, UTI, Nippon, etc. We should look at brokers as well, and let's just look at Motilal and IIFL and there's others like MK, etc., which are also listed.
3.5% lower on Motilal. Nuvama is down 3.5% as well.
Nuvama is a distributor as well. Let's look at Prudent Corporate Advisory. That is Prudent. That is the other one where perhaps there is going to be a bit of a impact, 3% lower on Prudent Corp as well. Okay, now apart from that, Jindal Steel we already mentioned. Shree Cement and Tata Capital are the others which reported numbers, and they'll come up on your screen. So nothing very much going on there.
There's Blue Dart also, Prashant.
Yeah.
In terms of result reactions, the ones that are really showing up, Blue Dart really stands
on your screen. 6.5% higher at this point in time. M&M Financial Services, Credit Access Grameen, Premier Energies, DCM Shriram, CAMS. All these are set up to open in just a bit from now. First, a couple of rates in a few seconds from now. 45 points on the Nifty, and we'll see how things are going to go. So 25,980 on the Nifty. The Nifty Bank is at 58,290. The sensex starts at about 84,700. The small cap index is down 0.2. The mid cap index will also come up on your screen. Absolutely flat, actually, unchanged so far, coming up right now. So 1,300 stocks are higher, and about 450 odd stocks are lower. This is basically the advanced decline ratio as things are coming up on your screens. We've got, the Nifty heat map on your screen now, and 40 odd names are higher, and some 10-12 names are lower. And it's a positive start overall, all told. Grasim, Max Health, Titan, and one end. And there is the Tata Motors passenger vehicle business, which is, I think the commercial vehicle business shares are in. Should start trading, I guess, in the next week, 2 weeks or so. Bharti, Bajaj Auto, etc. on the other end of the spectrum. So that's the heat map for you. Surabhi.
Okay, this whole MF, TER and charges overhaul, it's causing a lot of heartburn in the market right now. It's proposed changes. Look at Prudent Corp. If I have the right rates on the screen, Prudent is down 16%. The asset managers are, of course, down. That's the one that's taking a big knock, HDFC AMC. Nippon is down 6%. What else? UTI AMC is down about 3%. So these are the asset managers, the guys who make the product, manufacturing, mutual funds. But the whole ecosystem is down. Prudent is probably the largest, I think it is, in terms of volumes, they're the largest distributors of MFs in India. And the stock has been down quite a bit. There's IIFL Capital down 8%. There's Nuvama down 8%. There's Motilal Oswal down 5%. Just recapping the news for you. As of now, the regulator is saying that from the earlier level of 12 basis points as brokerage, now that cap is going to be reduced to just 2 basis points for all the cash market transactions that mutual funds are making. For derivative transactions, the cap is going to be reduced to just 1 basis point that can be charged as brokerage. And that's really, weighing on the entire capital market space, AMCs, brokers, and also some of the distributors. So that's one side of the market which is taking a huge knock. But on the Nifty, on to brighter things. Nifty still up about 70 points. So let's talk about the winners over here. HDFC Life is 1% up. Grasim 1% higher. Trent and JSW Steel are some of the other names which are up and about. Reliance is having a good morning. 1% on the higher side. There's L&T, which is reporting numbers. 0.6% higher on L&T as well. The entire auto space, by the way, has come in for profit taking this morning. M&M, Bajaj Auto, Eicher Motors, Tata Motors, all in a row. All down between 0.5% to 1%. So auto is profit taking, skidding. The rest of the market's holding up, but mutual funds, their distributors and their brokers, oops. Nigel?
getting knocked actually, some of those stocks. By the way, the stock of the morning has to be Mahindra & Mahindra Financial Services. That's the result of the morning. The stock is flying away as we speak, up close to around 6%. I think it's been a while since we said that, this company has reported such strong numbers. So the stock up and about. Sami Hotels, that's the other one that's gaining with a good amount of volumes. JSPL as well as Shree Cement, the numbers are a little bit subdued. Both of them were a little bit lower when the market just started off. But that dip has got bought into. Shree Cement, remember, the street was anticipating weak set of numbers because, it had underperformed. While on JSPL, the street is willing to look ahead. Capacity is coming on stream. Debt is moving down lower. And the street is focusing on basically the ferrous space will see better earnings. So that's why you have, Jindal Steel that's up and about. SAIL, it comes out with a set of numbers. The street is sniffing good set of numbers out here. I've seen in the past when JSPL delivers a weakish set of numbers, SAIL as well as weakish, because both of them have a higher exposure to longs. But this time around, it seems the street is actually sniffing that maybe SAIL could come up with this positive surprise. We'll have to wait by on that front. On the flip side, Cohance, the MD has resigned. That resignation announcement came in post-market hours. Spanked, just take a look at that, 10% lower on that particular name. So big downtick is what we're seeing out there. And IIFL Capital as well. My colleague Yash, in fact, had put out a story yesterday. There could be some fund infusion. We'll have to see the way this fund infusion does take place. But that one, in fact, is down in today's trading session. Another big winner from the broader markets is PPAP Automotive, a very small company. But I don't know that stock is up close to around 10%. We'll have to see volumes not high. So let's avoid that one. But dredging is up close to around 4.5%. So big move out there. And MTAR is another one that's up close to around 4%. So the markets, 50% up, mid-cap index more or less flattish, but the number of stocks advancing way more than the number of stocks that are declining.
Okay. I just want to reiterate once again what we've heard from not just experts, but their practitioners themselves, Ashish Sumaya and also Sandeep Bagla of Trust Mutual Fund, both concurring that the hit will, first of all, it will be shared between distributors and product manufacturers. And Ashish has quantified the hit to the extent of just 10 to 12 basis points. Now, that's his calculation. That's one person. But I think Jefferies is saying that it's about 8 to 10% of total earnings. Right, Prashant?
Yeah, 8 to 10% of earnings. And I think they put out something in the morning which was much larger. They've issued a correction in terms of... But I think Ashish was very, very detailed with regards to what's happened. By the way, a friend of mine messaged the equity sell side. Maybe a little dramatic, maybe exaggerating to make a point here. But he said that, well, if these goes through, it's basically... It's a hammer on the equity sell side industry. If say effective sort of rates of brokerage is, say, not 12. 12 goes to 2, but most don't pay 12. They pay whatever, 6, 8. 8 goes to 2. That's 75% cut to the revenue pool, right?
Yeah.
So time to join investment banking. Let's get in Pratik Gupta, who'll be able to, I guess, weigh in better here because he runs the business. Exactly that. CEO and co-head at Kotak Institutional Equities. Pratik, good to have you with us here. Good morning. Thanks very much for joining us. So it's not a market question to begin the day, but just a business question, if you will. And it's not so much about Kotak, but how do you think about what has been proposed with regards to this? It's like that India's MiFID moment. What happened in Europe? So what's your sense, Pratik?
Hi, good morning, Prashant. Yes, you're right. This is somewhat like a MiFID type regulation for the Indian mutual fund industry. And we're still going through the circular. So still trying to better understand the intent behind the circular. Because frankly, the entire mutual fund industry, as well as the broking industry, as well as the distribution industry is fairly competitive. It's not a monopoly or an oligopoly even. So usually regulators should, globally, they tend to don't really interfere in pricing. They focus more on things like regulatory aspects like, processes, insider trading, investor protection, etc. Pricing is left to market forces. So it's a bit surprising that we are seeing pricing caps in India and that too now being cut very, very sharply. Obviously, the impact would be quite negative for partly the mutual fund industry and also the distributors and brokers who service or who are very heavily dependent on the mutual fund industry. And we've seen this in Europe where, frankly, this has not really worked out as well and the regulator's been trying to backtrack. But once you've sort of cut the rates and once the end clients get used to not paying for research, not paying for brokerage, very tough to unwind that. Nobody wants to be the first fund in Europe who will start charging for that. It's a very competitive market over there as well. So let's see. I think this, in our from Kotak's perspective, we're a large firm. We can probably sort of absorb the hit. But I think it'll be very, very negative for some of these smaller brokers and also for some of these smaller mutual funds in particular. And even the larger funds and distributors, they will be impacted to some extent. And I think you will start seeing resources being directed more towards, away from mutual funds towards other categories like PMSs, AIFs, or foreign portfolio investors. So the end retail investor whom I guess SEBI is trying to look after, they may end up perversely getting impacted because they will not get the best quality service or the best quality distribution, etc. So let's see. I mean, I think this similar circular was there 2.5 years ago, somewhat similar, and subsequently it was taken back. So I don't know what will happen this time, but let's wait and watch.
Pratik, hi, morning. So, just to press on this point, then we have, of course, the overall market to address, and we'll get to that in a bit. The regulator's rationale seems to be that, look, why are you charging the end investor twice for research? You're charging him or her once at the expense ratio level, and then you're charging again as part of brokerage. So, I mean, purely thematically, that sounds like a logical argument, but clearly that's not how it's working out. Now, is it the quantum? Say if it was not, the cap was not 12 basis points, if they had, lowered it more gradually, brought it down to 6, 7, would that have been more palatable? And this is still open for discussion, I'm sure. I mean, that's the whole point of having a consultation paper, right? Industry is going to go back to the regulator on this.
Yeah, so I think firstly, let's look at global practices. Other than Europe, most other places it's left to open market forces. And if you go back in the 90s, for example, brokerage rates were as high as 2%, which were bundled rates, including sales, research, execution, everything. And that has gradually come down, even for FPIs, down to 20, 25 bips. And again, it's a function of volume. So it's a free market, and brokers charge whatever. Even when we service FIIs, we have different rates for different customers depending on how much servicing they're taking from us, etc. So the best thing in my view is encourage competition, let free market forces prevail, and a gradual. And we have seen even for FPIs, gradually rates coming down. So the end investors, people who invest in the Fidelities and Capitals and Templetons of the world, they have benefited over time from lower brokerage rates. And I'm guessing similarly over there on the distribution side as well. But a gradual decline would anyway happen. So that would have happened anyway.
Yeah. Got that. Do you have on the research side, now let's get to the market itself. Do you have a view on, capital market theme has been such a big theme, right? And it's created a lot of wealth over the last 4-5 years. Does something like this derail that at all? Or you think, the bigger story is financialization of savings. And that corpus perhaps keeps getting bigger and bigger. So that's a compounding story in that sense. Maybe earnings will have to tweak a little lower, but will that get made up by volume? We'll let us see. How would you think about this, Pratik, from a stock perspective?
So firstly, as far as the financialization theme is here to stay, as you said, so therefore the long term on a 5-10 year view perspective, these are great businesses. You will get these regulatory shocks or otherwise other kind of shocks from time to time. But I think the way to think about it, the way at least I would recommend thinking about this is industries or companies which are in somewhat of an oligopolistic or monopolistic position. They're more vulnerable to regulatory intervention when it comes to pricing or, with SEBI or anybody else doing something to control their profitability. So I would obviously, our preference is towards the likes of mutual funds or the wealth businesses where it's an open market, you're competing out there, and if you've got a good business, good product, good people, good service levels, you will hopefully gain market share and continue to benefit from the financialization theme. When it comes to, let's say, exchanges or other kind of market intermediaries which are either monopolistic or oligopolistic in nature, that's where you have to worry a lot more about regulatory intervention. So that's where we would be somewhat careful. The only other point I would make right now is this theme has been talked about quite a lot. These stocks have done very well, and at current valuations, we are finding it a bit difficult to be positive on these from a somewhat of a short-term 1-year kind of a time frame. If you have a slightly longer time frame, then it's fine. But over a 1-year time frame, we think the valuations are now getting a bit expensive.
Okay. Valuations are turning a bit expensive. Got that point. Prateek, overall, I mean, when we talk about this whole earnings revival, because the entire market is pinned on two things, I guess. One is this trade deal getting finally signed, but more importantly, earnings reviving, right? Now, in which sectors do you see some hint of durable demand pickup and actually some sort of a move towards that elusive double-digit earnings mark? I mean, if you could just maybe prioritize and lay out the sectors for us.
So, Surupi, that's actually a challenge. In fact, just this morning, we were discussing in a morning call, TVS Motors has guided that second half auto sales for two-wheeler ICE industry will probably be just 8 or 9% or so. So we're already seeing signs and comments from companies coming around that the GST boost or the festive season boost that we saw in consumer demand, that may be petering out, may not sustain. And the fundamental problem still remains job creation or income growth for a large section of the population. And for that, you need manufacturing. For that, you need exports. You need more formal job creation in the IT services sector, the startup ecosystem, which has slowed down in the last 1 year or so. So therefore, there aren't that many sectors, which is why we're still somewhat cautious on the consumer sector. The entire consumer staples pack and many of the discretionary names also, we're still somewhat cautious, especially given valuations where these stocks are trading at. Some are still trading at 50 times, 60 times even now. So that's one space we're sort of cautious on. But where we think there might be some hope is the banks. The latest fortnight, you've seen credit growth picking up to about 11.5%. We think with the way the RBI is deregulating or liberalizing a lot of rules and guidelines for the banks, especially the large private banks, we think they're very well positioned. Even some of the mid-sized ones. But the banking sector is one where not only do we expect growth to pick up, because without credit growth, you will not see the overall economic growth picking up. So that's one. And second, the valuations are also a lot more reasonable compared to, say, 2 years back, and especially compared to the rest of the market. So that's why I think, frankly, banks, insurance, life insurance companies, and maybe hotels, airlines, those kind of companies, telecom, we're expecting ARPU hikes over there. So let me just, pause there for a minute. But those are some of the sectors we like.
Prateek, in interaction with clients, has domestic politics entered the conversation at all? Bihar, etc.? No, not really.
No, not really. Most people are not taking it very seriously. I mean, the general assumption is the incumbent parties will win, which is the BJP-led coalition. So if there is an adverse result, that will be taken as a little bit of a negative, but it's not a major talking point with investors. They are looking more on what is the government likely to do with economic reforms after GST what are the other reforms they have in mind, and what about government capex and so on. So it's more about those kind of issues. And obviously, there is the global factor about EM funds. When will they start getting money? When will the foreign selling stop? In fact, it seems to have come off, or rather, it's turned around a bit in the last few weeks. So is that sustainable? So that's really more of the talking point, not so much the Bihar elections.
It's just a slightly, it's not more of a, maybe there's a question here, but just wanted to ask you, the Lenskart IPO, right, which opens, I think, tomorrow or day after for subscription. I don't know if Kotak is involved or if you can, are you guys there?
Yeah, we are involved, so unfortunately I won't be able to talk specifically about Lenskart.
No, I mean, I know, I guess you would have guessed where my question was going, which is valuations here, and so much feedback from people, right? And you would have noticed that as well, that while, the the promoters and the founders, etc., they tried to sort of reach for the maximum value out there. But, you know, isn't it the lead managers and the bankers, etc., who are perhaps to, you know, sort of advise and moderate some of this? But I guess, would you be able to weigh in at all? It's not a question for you on Lenskart, but it's just a broader question, Prateek.
So I think this would be probably a question better for my IB colleagues. But in general, typically, as you know, pricing is again determined by market forces, just like what we were talking about in the broking industry or the distribution industry. So likewise, you could have managements which may want, you know, let's say a price of 100. But if investors are there at 60, then there's a big gap. And eventually, you know, somewhere there's a lot of negotiation and discussions happen. And either managements have to come down or investors have to come up. So these are market forces working around, and it depends on various factors, including positioning, sentiment, confidence in the company's growth prospects, flows at that point in time, cash levels at that point in time, overall market sentiment, foreign participation, how that's progressing. So there are so many things which happen. So I don't think beyond a point, frankly, the bankers can't do too much. It's at the end of the day, our guys have to try and make sure the transaction goes through and it performs well in the aftermarket. But again, if you have a group of investors who are willing to pay a very expensive price, then the pricing does move up, and that in turn may negatively impact the performance later on. But usually we do try and make sure that the IPO performs well. But again, like I said, these are market forces, not much we can do beyond a point.
Maybe we'll try and have the people on the investment banking side, as you said, Prateek, and maybe it's a discussion to be had. We'll try and have it. Thanks very much for joining us. Good speaking with you, and appreciate your time here on CNBC-TV18. 50 points on the Nifties, where we are at 25,990. Well, let's go back to the big story, which is, of course, the SEBI draft regulation rules with regards to mutual fund fees, distribution, commissions, etc. And the entire capital market space taking a bit of a knock this morning. Sonal is here just to recap and put the spotlight on the various businesses, groups within the ecosystem which are likely to get impacted. Sonal, take it away.
Thank you for that. Well, it's a big proposal to reduce fees or basically restructure the fees that mutual funds charge to their investors. Let's talk about the big ones which could impact the markets overall. The first is 5 basis points cut in the equity exit load related charge that can impact AMC profits. They basically have asked to remove that 5 basis points charges that were levied. And Jeffrey says that if there is that 5 basis points that cut that comes by, it could impact AMC profits by 8 to 10% if it is implemented by FY27. Remember, it was implemented back in 2018, and now there's a proposal to quash it completely. There is proposed lowering the cap on brokerage fees paid by mutual funds as well. For cash market transactions to 2 basis points from 12 basis points. For derivatives from 5 basis points to 1 basis points. This is basically the charge that mutual funds pay the brokers when they buy the stocks in their portfolio. And of course, this would be negative for institutional brokers, be it the likes of 361, Nuvama, all of them which are a part of the brokerage ecosystem when it comes to the mutual fund industry as well. Additionally, we have proposals of reduction of expense ratio by 15 basis points for open-ended schemes, up to 25 basis points for closed-ended schemes. And they also indicate that statutory levies like STT, GST, you have stamp duty, that will be shown separately. They want to bring more transparency. They want to make it more investor-friendly, and that is why they proposed these changes. However, these are just proposals. Comments are awaited, and the last date for the same is 17th of November.
Okay, all right. Got that. Sonal, thank you very much for getting us the details there. A lot of these stocks are still reeling under pressure. As you can see, some of the broker stocks are still down. I'm just checking IIFL Capital, for instance, down 9% as we speak. CAMS is down 5.5%. And of course, the asset managers themselves are decidedly lower, at least as of now. Well, we have to discuss this issue and the other important piece of news yesterday. India's largest commodity exchange, MCX, suffered a technical glitch in trading, and finally trading resumed 4 hours after that glitch was reported. And this is not the first time that MCX has had to face something like this. It is the second such instance in just the last 3 months alone. To talk about this and the fact that the market regulator is now seeking a very detailed review and a response from MCX, we have with us Abhishek Dadu, partner at Khetan & Company, and also Sandeep Parekh, managing partner at FinSec Law Advisors. Gentlemen, thanks so much for joining in. Just when we thought we'll discuss what SEBI wants to know on MCX, SEBI wants to know a lot more from mutual funds as well with respect to their charges, right? So let's take it step by step. But first on MCX, Sandeep, your opening thoughts, because this is happening repeatedly. There is obviously a loss of opportunity and real losses as well, because you cannot trade real time. So how do you see this progressing? And do investors or traders who trade on the exchange, do they have a recourse?
So, I think let me start with a little bit of, background to technology. We've seen technology failures across not just the financial industry, but across, last week itself, practically the entire internet was shut down because of Amazon failure at the back end. So, wherever you have technology, failure is bound to happen. I think the point really is how prepared are you? I think the back office, the backup system worked yesterday. So I wouldn't be too worried about it. I think there will always be takeaways from technology failures, how to kind of make it smoother, how quickly you can move to disaster recovery site, etc. But to say that technology glitch will not happen, if it happens to Amazon, it can certainly happen to anybody else as well. So I won't be too skeptical about, these are failures. They've certainly had a kind of a shift in technology over the past 2 years. So, maybe they're a little more vulnerable, but, like I said, I won't be too skeptical about failures which are remedied quickly.
Gentlemen, morning, Sandeep. Absolutely, but and we face technology failures all the time as well. I mean, sometimes I'd be on air and my computer would not work, and I'd call IT support, and it'll take time. But this is different, right? You surely agree. This is not, and no, it's no one's case that technology cannot be, would not, there won't be problems as you pointed out with AWS, etc. But that disaster recovery, correct me if I'm wrong, isn't it supposed to kind of work like seamless? It's supposed to work seamlessly, right? Something goes down. That's the whole point of a DR site.
Most DR sites do take a few minutes. I don't know how long it took yesterday.
4 hours.
4 hours, 25 minutes.
4 hours, okay. So, like I said, there are always learnings from problems. Again, comparing it to last week itself, for 48 hours, we did not have, 50% of the internet for me at least stopped working completely. So certainly, can we make that 4 hours into maybe 1 minute or 2 minutes? Certainly, yes. Is it instantaneous? Usually, no. So there will be learnings. There can certainly be improvements, but I don't see a case for penalties being imposed and kind of a heavy-handed approach being taken in a case like this.
Abhishek, you want to come in? Your first thoughts? How would you think about this?
So again, I agree. I think, look, there is a much higher standard that applies to an exchange, right? There's a lot at stake here. It is a market institution. There is price discovery at stake. And I think more than anything else, the mere confidence of all the investors and the market in general is at play. So it's very important for the backup to come into play quickly. I know that there is a standard operating procedure which has very strict timelines that come into play. We still don't know whether these timelines were met. Of course, there will be a preliminary report followed by a root cause analysis report. These are detailed reports. All the processes are set out in law for MCX to submit to SEBI. Now, it needs to be seen if this has happened twice. Clearly, there is more there. And they need to fix the problem more quickly. So I feel a little more strongly about this. I think this is something that needs to be taken a lot more seriously and fixed. Minor glitches come, but they can't come this regularly.
What do regulations say, Abhishek, about something like this? What needs to happen once this happens, once the disruption happens, and what does it say?
Right. So typically, in brief, what it says is within 30 minutes of effectively the trading halting, you need to declare it as a disaster, right? And then within a certain timeline of that, around 45 minutes or so, you then switch over to the disaster recovery.
No, 30 minutes, with 30 minutes, 30 plus 45, or from the point this trading is disrupted, 45.
It's 30 plus 45.
Okay.
That's the standard operating procedures say that. But there are nuances to this. It is when you actually declare it a disaster. Now, those details we don't have handy because those would be something available only internally and with SEBI at a certain point in time. But the idea is that there are strong financial disincentives which are imposed on the exchange if they don't meet these timelines. Right? So from an internal perspective, the exchanges are incentivized to make sure that these processes come into place as quickly as possible. And we'll have to wait and see how SEBI and the exchanges deal with this instance, especially since it's the second time around, the last one being as recently as July.
So this was not 30 plus 45. This was clearly longer. And, I just want to make clear, no one is here saying that, well, there should be, SEBI should come down hard and do this or do that. We're just discussing because it affects, and this is the dominant exchange, right? By far the dominant exchange for commodity trading. So it's an important matter in that sense. Abhishek, so you mentioned there are strong financial disincentives. What are they specifically?
So there are two thresholds that are applied. It's the higher of 2 crores or 10% of the average net profits over the last 2 years of the exchange. And
say that again, Abhishek, 2% for our viewers.
So it's the higher of 2 thresholds. The first threshold is 2 crores and the second is 10% of the average net profit of the exchange on a standalone basis over the last 2 financial years.
So the cap, the maximum hit can be 2 crores.
No, higher.
The higher of. Okay, yeah. The higher of. So it could be as a percentage of profits.
Correct. Yeah.
Okay, and that's important information that, MCX is a listed entity. So MCX shareholders, it's important for them to understand the way the current rules are worded and what eventually comes out after this, out of this investigation that SEBI
but I
has
think,
launched.
It's also true that I don't think this has ever been applied, or has it? I don't know if you can ask Abhishek. Have these penalties of this sort been applied, Abhishek, in your memory?
So not to my mind. I know that there have been general sort of raps on the knuckle, but look, the regulator and the exchanges are also mindful that these are mostly genuinely out of control instances. Right? We have to also be mindful that MCX has recently moved to a new platform from its earlier one. As Sandeep mentioned, glitches, certain teething issues are expected. It's just about getting better with every such instance and ensuring that they don't happen again. I think as long as sort of good faith and that approach is exhibited, the hope again here is that the regulator is there to sort of support these institutions as opposed to look at it from the perspective of purely trying to penalize them for a technical glitch.
Okay. Well, we hope that good faith is guiding, of course, all of the responses to start the disaster recovery and hopefully making systems better so that we do not have outages like these and definitely not as long as what we witnessed yesterday. Gentlemen, before we let you go, and since we have you with us, Sandeep, just your thoughts, since we're talking about market infrastructure institutions, the entire ecosystem, mutual fund, product manufacturers, their brokers, distributors, everyone is in a disarray this morning because of what the regulator is proposing, saying that you can't charge brokerage beyond 2 basis points. And even that additional 5 basis points that they could charge in lieu of the exit loads being banned, even that's going to go. So the whole sphere is in disarray. Just your thoughts on how this could play out.
So, let me first kind of go back to your previous topic and I'll seg into this topic.
Yeah.
I think you asked, what is the penalty? What is the disincentive? I think capitalism is a big disincentive. If your technology fails, I think you are put at a severe disadvantage. So there is a reason for you to self-correct. And, I'm making this point because is very relevant to this question which you asked for mutual funds, for brokers, etc. I think so long as the market forces work, I don't think there should be fee caps really. And I say this, despite being part of the mutual fund committee in 2019 when the the fee cut happened. That time I think the MFAC was convinced that the market forces did not effectively work, and that's why the caps had to be reduced. But today, I think it's a pretty competitive market out there, and I don't see why you need to kind of including what you kind of flashing right now. 12 basis point and 2 basis point brokerage. I think that's extremely low. Even 12 is pretty low. Most of us pay significantly higher brokerage for full service brokerages. So unless there's kind of demonstrable evidence that market forces are not working properly, I think there's no reason to kind of impose new price caps. I think the existing caps should be sufficient. And secondly, do remember there is a second order problem with these price caps, which is it does disadvantage new players. It disadvantages smaller players because it will make them either less viable or make them viable over a longer period of time with longer gestation period.
Usually the way the TER structures have been created, usually it is people with the lower sizes of funds. They do get higher TER. So precisely that objective that you're saying. Very quickly, last 30 seconds for brokers, Sandeep. I mean, right now you look at stock prices, it seems like the end of the world is coming. The model of equity broking as we've known, and largely, I mean, their FIs have been absent from the market, so it's domestic flows, and within that, mutual funds are a huge part of where the business comes from. And if that is capped at 2% broking fee, then what are we talking about in terms of just the immediate future for domestic brokers?
Not 2%, 2 basis points.
2 basis points, beg your pardon, 2 basis points, yeah.
So, no, I'm laughing because, I think 2 basis points is really low. I think, like I said, unless there's evidence that there's either cartelization, that the market doesn't work, and there has to be price caps, I think we should trust capitalism to work. Trust competitive markets to work, and as far as I know, they do work. I would not kind of support these new price caps. Again, I can be subject to correction if there is evidence to the contrary.
Okay, so let market forces work, let the forces of capitalism, demand, supply, fair markets and competition take over. That seems to be the message from Sandeep on this one. And thank you very much, Abhishek, for joining in as well. Both very important subjects, the huge outage that we saw at the biggest commodity stock exchange, as well as what SEBI is now proposing for mutual funds in the entire MF ecosystem. Well, with that, we do have to take a quick break. And as we take that break, here's a quick note for our viewers. As you can see on the screen, there is a money control stock score just above the MCX line graph. This is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameter is considered for calculation of the 4 factors are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor or viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions. Well, on that note, let's take a quick break. On the other side, we talk about the primary market action. The management of Orkla India will be chatting with us as the company is all set to hit the capital markets with an issue which totals to just under 1,700 crore rupees. Back with that in just a bit.
Welcome back. This is Corporate Trader, and as promised, we have the management of Orkla India who are in our studio with us. They are looking to raise close to 1,660 crore rupees. The issue opens up for subscription today. To understand what's the company about and what's the way ahead, we're joined by Mr. Sanjay Sharma, the Managing Director and CEO, and Ms. Sunaina Kalapa, the Chief Financial Officer of the company. Hi, ladies and gentlemen. Thanks a lot for coming down to our studio. Well, obviously, you'll be able to give us limited details since the issue just opens up. But tell us, how do you see business, shape up from here on? Now, just looking at your revenue mix, how do you see, say, for example, spices as well as prepared dishes? That makes shape up in the time to come. And also, the export proportion has been moving up. So, what's the ideal mix out there?
Yeah, thank you. Thank you for having us in your program today. I think from a revenue mix, from a future revenue mix point of view, I think the drivers are quite clearly laid out. I think as the per capita income in India continues to develop and the GDP continues to develop, we will see a shift from the unorganized market to the organized market. Mm-hmm. I think that's something that has happened across multiple categories. You've seen curd go through, you've seen oils go through it. You've seen atta go through that shift as well. So you will see a shift continuing to happen. The second driver in our minds for growth is going to be the convenience food category. I think over the last 3 years, I think the indicators are falling in place very well. We see the new generation of consumers becoming the dominant consumer base, which is the millennials and the Gen Zs. We also see that these people, there's a higher proportion of women working, lesser time at home, lesser knowledge of cooking. But these guys are all internet savvy, digital savvy people. So they access their knowledge from the internet. So if I'm cooking something and I don't know how to cook, go to YouTube, quickly push through a recipe out there or on Instagram and pick up a recipe from there.
Indeed.
Order the ingredients from a quick commerce, comes to you in 10 minutes.
Yeah.
I think, and they're not scared of digital payments or not checking the quality of products and other things. So I think these are factors that are driving the overall growth of both the categories.
Let me come in on that, sir. If you could tell us, you started off by saying there's a shift, right, from the unorganized to organized. So tell us a little bit more about that. What was it? What is it? And how is it? Where is it headed?
Yeah, so if you look at let's take spices market. Today still 60% of the market is unorganized, right? Your grandmother and my grandmother used to go to the market, buy the masalas, buy the spices, roast it in your house, grind it and make your own spices. They would mix them up and make their own masalas. My wife doesn't do that. My wife probably has many better things to do in her life, so she will go and buy a branded spice for that. So I think that is driving the shift. And today, as I said, 60% of the market is unorganized. So as people have more income, I think the shift is more towards lack of adulterated food. People want to give their children the very best food because food is life in India.
Absolutely.
Food is good health in India. So, and spices has got a lot of connection to health as well. I mean, jeera is good for your stomach and so on and so forth. So I think that shift is going to happen.
So as that shift happens, now I just want to, I know you can't talk too many numbers right now because of, the issue. But generally speaking, when we talk about top line growth, and investors need to understand this because you've been doing a bunch of acquisitions as well, right? 2021 was, I think, Eastern Condiments. Going forward, what is the revenue growth trajectory for you like? I mean, what is the aspirational run rate? Will it be organic? Will you continue looking at inorganic opportunities? Are you looking to grow the spices portfolio more or the ready-to-eat foods portfolio more, depending on where profitability and margins are more lucrative?
Yeah, so I think before I do that, let me just step back and reiterate one fact that we don't play national, right? We play South. We are 70% of our revenues come from South, and the reason why we play South is because food is local. Gujarati food is different from Maharashtrian food, which is different from the Kannadika and the Tamil. Even the Tamil and the Kerala Malayali food is very different.
But I can tell you, your gunpowder chutney makes it to this North Indians home on a weekly basis. So, therefore, it's pan-India.
You consume it weekly, but our consumers consume it daily.
That's true.
And I'm looking for depth of consumption out here. So, our entire strategy is to drive depth. Now, let me give you a very interesting example. Today, over the years, we built our per capita sale in Karnataka from 16 rupees to 110 rupees. What is 110 rupees? I mean, our largest selling pack of sambar is 76 rupees, right? For 100 grams, which means I'm selling 120 grams of sambar to every person in Karnataka annually, right? When that is so, when you make one time sambar, it takes about 10 to 15 grams of sambar, which means I'm covering 12 consumption occasions in a year. You have 260 consumption occasions because sambar is made 5 times in a day, right? And
so there's
huge headroom for growth, even in our local spaces.
But organic or inorganic? I mean, coming back to the question.
Organic. This is what we've been doing for the last 18 years.
Correct.
So, we've been pushing, we work on 4 factors. We work on driving penetration, driving frequency of consumption. We have a range of 200 products each on both the brands. So it's about...
But you're not looking to snap up more inorganic brands because it is a largely unorganized market. I was just trying to understand that. Whether the focus is going to be on more acquisitions or just pure organic growth?
I think acquisitions is an important factor for growth. But I think today, we have always delivered double-digit growth in the long term. And we will continue to do so in the future. And if we have to do so, and when I'm talking about that, I'm really talking about driving it through organic growth. Acquisitions, are far and few in between to come. We will continue to pursue that agenda.
Let's just step back a little bit. So for the viewers who are, so there is the MTR business, which is the brand which consumers are aware of. What is that as a share of your overall business? MTR?
Yeah. So MTR is about roughly 53% of our total.
And what are margins in this business?
I can only say that the margins are extremely healthy because MTR has a very healthy portfolio of convenience foods as well as spices. And the focus, again, in spices is more on blended spices, which delivers higher gross margins. Similarly, convenience foods also delivers higher margins. So the margin
53% with healthy margins in MTR. Now, Eastern, what is the share?
So Eastern is about 47% of total revenues. And in the case of Eastern too, over the last 4 years since the acquisition, there has been a tremendous improvement in the gross margins as well as the EBITDA margins. We've put in place a lot of initiatives to grow the margins. However, because of the portfolio, it is slightly behind MTR in terms
international business is about 20%. Exports are about 20%.
21%, yeah.
Okay. And locally in India, 70% is South, as you said.
Yes.
Some of the key
70%
numbers.
70% is domestic, and then 70% of that is South.
When you came on, you started by saying that young people, they look up recipes and then they order ingredients. Yeah. But they also, through these quick commerce platforms, order the food directly. So since QSR became so big, has there been any correlation? Have your sales... per unit sale, I mean, is there any way to tell, has it dropped with QSR? I mean...
So let's talk about it like this. Anything, if you stop cooking at home...
Not QSR, sorry, beg your pardon. Food delivery. Yes.
Food delivery.
Food delivery.
Every time you don't cook a meal at home, it affects our business, right? But I think India is a large enough market to accommodate all kinds of models. So, of course, ordering out is new and fancy in this country.
But has that been a point where, there's been no impact?
I think it's, as I said, India is a large enough market. I don't think we have reached a stage where these markets have started to interact, right? I should also tell you one thing that, it's nice. We are talking about largely the India consumers, large city kind of syndrome. Spices penetrate right down to rural. It's an everyday consumption for everybody. Okay, so there is a huge market which is still not affected by all this. People still. Again, it's the India A consumer who has the money to order frequently outside. Large amount of population in India does not.
My question only was whether there's been impact on ready to eat. Spices, of course, is... would you be able
I think both the markets are very small. The ready-to-eat market is very small at this point of time, and so
would you be able to split out the revenue contribution of spices specifically? Because there is spices in Eastern and MTR as well.
I think you want to take that.
So spices roughly contributes to about 67% of our total revenues, and 1/3 of the revenues comes from convenience foods for us.
Okay, with obviously convenience foods having a higher margin profile.
No, that's not right, Surbi. Blended masalas give us very high margins as well, yes.
Okay, all right, ladies and gentlemen, thanks a lot for coming down to our studio. We wish you all the best. And on listing, we'll re-invite you all on the show. And then, in fact, maybe we could push you all for a little bit more numbers and quantitative data.
Certainly.
Thank you. Thank you very much.
Good luck.
Thank you.
All right, let's get back to our markets then. The Nifty continues to hold with gains of close to around 60 points. And after a very, very good showing in October, November starting off on the front foot. Vinay Rajani, the senior technical and derivative analyst, joins us on the show. Hi, Vinay. Good to see you, Vin. What do you think? All-time high sooner rather than later? What are the levels you're looking at, though?
Yeah, good morning. So yes, it looks like that we should soon hit an all-time high. Data from the derivative side, the rollover data has been encouraging. The Nifty has risen more than 5% in the October series, which is highest since June 2024 in the derivative side. So it is quite encouraging, though we have not seen the broader market participation that much. But large cap stocks are performing very well. Right now, we are oscillating between 26,100 to 25,700. So consolidation is going on. But anytime soon, we may see a breakout about 26,100. That is a swing high resistance that we are right now tracking for the short term. And long positions, we are advising to hold on with a stop loss of 25,700. So overall scenario is good. Result season is going on. So stock specific moves will be there. Some sectors are still performing very well, like metals and PSU banks, which are performing and hitting new highs. So stock specific, sector specific bullishness is continuing. Right now, we are into consolidation, waiting for 26,100 to be taken out, and then we can expect a good momentum buying coming back to the Nifty, which can push it towards the 26,600, which we are targeting positionally in the Nifty.
Okay, got it. What about individual stocks?
Yeah, so metal stocks we continue to like, and it is looking quite strong. So Jindal Steel and Power, which has given a fresh breakout on the chart. So Jindal Steel and Power, I would recommend to go long for the trading around 1084. 1065 should be the trading stop loss. 1115 should be the next target in next couple of sessions. The second pick I would take from the power segment, that is Tata Power, which has also given a fresh breakout. This is a sector which has not participated that much, and it seems that this power sector can come and participate in this bullish rally. So Tata Power is looking good around 406. 398 should be the trading stop loss. On the upside, I'm expecting a target of 416.
Okay, all right. Thanks a lot, Vinay, for joining in and giving us all of those details. For the time being, slip into a short break. And since Vinay mentioned about metals, we'll take that break, come back. Manisha is waiting for us. She'll tell us what's going on in the commodities market. Don't go anywhere.
Okay, welcome back. Let's shift focus to what's happening in the commodity space. Manisha is standing by now with what's top of mind. Manisha, morning.
Morning, and thank you for that, Prashant. Well, copper is the new gold is what we seem to be hearing right now. And yes, there is some money that's coming back in case of copper right now. If you look at the prices on LME, they are very close to all-time highs. 11,000 plus is where we are trading right now. An all-time high in case of copper was hit in May 2024. At that point in time, we did see copper prices going all the way to 11,104. So as I said, not even $100 away from hitting an all-time high when it comes to LME copper. As far as COMEX copper goes, well, we did see an all-time high onto that one in this year at 5.93. We are trading at $5.13 a pound. So it has been a very market of disparity, and it continues to be like that, whether it's about LME and the New York copper prices therein. Well, there is renewed optimism over markets therein on impending conversations or US and China deal. That seems to be supporting various risk-friendly asset classes, and copper is one of them. If you look at the dollar index, we've seen a 7% decline on that in this year. That has been supportive for many dollar-denominated commodities. It also is about copper and its uses, really, which is getting more essential now for renewable energy systems, EVs and power grids, in addition to electricity and electronics as well. The kind of AI demand that seems to be coming in from copper also has been quite supportive. And then it also has been about major producers talking about concerns when it comes to mine supplies and smelting as well. That is supportive. For example, you have Codelco's El Teniente mine in Chile, which is looking at lower production this time around. Then you also have Dominican Republic and major sites therein which are facing problems as far as mining is concerned. Congo, Republic of Congo, that is also getting some issues there. And then that Grasberg mine in Indonesia, the Freeports mine, has been looking at lower production. An expectation that you could be looking at this mine completely recovering only by mid-2027 tells you that we have that much time for copper prices to continue to be on the bullish side there. And then you have had some alerts and warnings as well. Anglo American, for one, says that the production from its Chile's Collahuasi mine will be looking at lower production in 2026 and would see recovery and back to normal only by 2027. So that is 3 mines telling you that the production would be back to normal by 2027. And then you have BHP's statement from the CEO coming, saying that global demand for copper could surge by 70% by 2050. So are we looking at higher highs in copper? Well, that is something exactly what the global banks and brokerages believe. When you look at the prices itself, we've seen 4% of a gain in the previous week itself, and we are up by 30% in copper in this year until now. More importantly is what banks now seem to be putting out in sense of numbers for copper for 2026 and 27. There's a report from Bank of America which came in very, very recently. They believe that copper prices could see 11,300, a new all-time high in 2026. And by 2027, before the prices peak out, you could be looking at $13,500 a ton onto that one. A report from Citi believes that 12,000 is inevident by 2026. That's an average price that they're putting out. And then there is Goldman Sachs. They have come out with a report for 2026 and 27, believing that $10,000 to $11,000 a ton of an average price is what copper prices could be trading with. JP Morgan also has come out with various scenarios, ifs and buts, and for 26 and 27, they believe that copper could trade between $9,500 to $12,000 a ton on the higher side. So as you can see, the bullish picture for copper just about continues, not just in this year, but the next couple of years as well.
All right, Manisha, thank you very much for that. So that is Commodities in Focus. We take a break. On the other side, it's the economy. Lata in conversation with Jonathan Barrett of ETO Markets and Kishore Narni of Motilal Oswal Financial Services. And we'll put the spotlight on if metal prices are on the verge of a major rally from here. Copper and other commodities in focus.